Now let's examine the first type of adjusting entry in a little bit more detail, converting assets into expenses. Recall from the previous module that the first adjusting entry involves a debit to an expense account and a credit to an asset account. Three common examples of the types of accounts that would require this type of adjusting entry at the end of an accounting period include supplies, prepaid expenses, and depreciable fixed assets. Recall from prior modules that some firms choose to expense their supply purchases immediately when purchases are made, rather than expensing them when they are used up, assuming that they're immaterial. While this is at odds with the matching principle, which does require the cost of supplies be expensed as they're used up to help generate revenues for the firm, firms are permitted to treat supplies purchases in this manner as long as the amount of the supply purchase represents an immaterial amount. So as was previously mentioned in a prior module, if your supply purchases represent a very immaterial amount for the firm, it can be more costly to try to account for them following the matching principle than it is to just expense them as incurred. So in those cases, the supply account does not need to be adjusted. You don't need to do an adjusting entry because you don't even record supplies as an asset. However, when supplies purchases do represent a material amount, and for many firms supplies do represent a material amount, firms are required to capitalize the cost of their supplies as an asset at the time of the purchase and delay the recording of supply expense until supplies are used up so that you can match the revenues that those supplies help generate with the cost of the supplies. For these firms, the adjusting entry is necessary to make sure the supplies asset account is not overstated and to record supply expense appropriately in the correct period. Consider the following example. ABC Inc. begins the year with $1,000 worth of supplies on hand. This $1,000 represents an asset on ABC's balance sheet, which would be represented by a debit balance on the supplies T account. If they purchase $600 worth of supplies throughout the year, this would increase their supplies balance by $600, which would be added on the debit side to the supplies T account. And after this purchase, it would appear as though $1,600 worth of supplies should be on hand, the $1,000 that we started with plus the $600 that we purchased. However, if at the end of the year ABC counts the inventory and they only come up with $700 worth of supplies, we can deduce that we must have used up the other $900 worth of supplies, because that's the only way we can get from the $1,600 balance that we should have to the $700 that's on hand. Somewhere along the way, we lost $900 worth of supplies. So in this case, that would represent the adjusting entry that needs to be made to the supply account. If we keep it at the 1,000 plus the 600, we'd be overstating our supplies because we don't have $1,600 worth of supplies. We have $700 worth of supplies. And the adjusting entry gets us from the $1,600 down to the $700 and records the appropriate expense of $900. The adjusting entry debits the supply expense T account and credits the supply T account. A second example of the first type of adjusting entry involves prepaid expenses. This is another example of how you convert an asset to an expense. And these types of expenses generally involve assets with a specific term duration that the company acquires and pays for at the beginning of the asset's term. So a typical example could be an insurance contract. If you prepay for an insurance contract, you pay for it all up front, and that insurance covers you for a specific term. In this example, ABC purchases a 3-year insurance contract on July 1st, 2009 for $36,000 cash. So what that means is that ABC has to credit their cash T account, and they debit a prepaid insurance asset for $36,000. Now, over the course of the next 3 years, they're going to use up that $36,000 insurance, and that's going to help them generate revenues in the future. But what we're going to do is we're going to record that $36,000 insurance cost evenly over the 3 years. So if they're preparing annual financial statements on December 31st each year, then the first adjusting entry that needs to be made is on December 31st of 2009. To calculate the amount of the adjustment, we take the $36,000 divided by 3, which gives us annual insurance expense of $12,000. So for the year, each year it's costing us $12,000 to have this insurance. And since in the first year we engaged in the insurance contract on July 1st, we only want to take 6 out of the 12 months, so we only want to record 1/2 of a year's worth of insurance cost, which gives us $6,000. That provides us with the adjusting entry, debit to insurance expense of $6,000 to record the cost of the insurance for 2009. And we also need to adjust prepaid insurance down $6,000 with a credit of $6,000 to reflect the fact that we don't still have $36,000 worth of an asset at the end of 2009. We've reduced it down to $30,000, which reflects the 30 months that we still haven't used up of this insurance policy. If we move forward to 2010 to see what the adjusting entry would be at the end of 2010, we're going to once again want to continue allocating this $36,000 purchase price evenly over the 3 years, but now we've got 12 months because we have a full year of 2010 worth of insurance. So instead of it being a $6,000 adjusting entry, it's going to be a $12,000 adjusting entry for 2010. And the adjusting entry is a debit to the insurance expense to record the expense, and a credit to prepaid insurance to reduce our balance from the $30,000 balance that is currently on our prepaid insurance T account down to the $18,000 that remains after this year, because we've used up another 12 months of that insurance. So we wouldn't want to overstate that. A final type of adjusting entry that involves the expiration of an asset is the entry to record depreciation on a fixed asset. If ABC purchases a truck on October 1st, 2008 for $100,000, and they estimate the truck will last 4 years and will have a residual value of $20,000, and they want to depreciate the truck using the straight line method, in this case, we've got a productive asset that we expect to help us generate revenues over 4 years. And what we're trying to do is assign that cost or match that cost of that productive asset to the revenues it helps generate. So we initially record the truck at its historical cost of $100,000. Now we don't want to spread the cost of $100,000 evenly over 4 years, because if we did that, we would reduce the value of the truck down to zero. And we really only want to reduce the truck value down to its residual value, because we anticipate that after 4 years we're going to be able to resell this truck for $20,000. So the real cost to us for this 4-year period is $80,000. The $100,000 we're buying it for, less the $20,000 we'll be able to sell it for in the future. Now there's a calculation to get straight line depreciation, which is essentially what this company is going to have to record. And the way you calculate straight line depreciation is by taking the cost and subtracting off the residual value and dividing it by the useful life. In this case, the truck cost $100,000. It has a residual or salvage value of $20,000, and the estimated life is 4 years, which means that the annual depreciation for this truck would be $20,000 a year. Since they bought the truck in October, we're not going to be able to depreciate a full year at the end of 2008. We're only going to be able to depreciate October, November, December, so 3 out of the 12 months, which means that the depreciation recorded for 2008 is only $5,000. The journal entry to record depreciation is a little bit different than the 2 previous journal entries. Rather than crediting the truck account directly, we're instead going to credit an account, a contra asset account known as accumulated depreciation. And the purpose of accumulated depreciation is to accumulate the depreciation on a fixed asset in a separate account so that we can keep the truck at its historical cost. There's a historical cost principle in accounting, and the reason we have two separate accounts, the truck kept at historical cost and the depreciation of that truck accumulated in a different account, is because we feel there's a value to creditors and investors to knowing what you paid for a truck, not just what its carrying value is. So we do leave the truck alone at the $100,000, and we reduce the value of the truck through an accumulated depreciation account. So the carrying value of this truck at the end of 2008 is $95,000, or the book value of the truck at the end of 2008 is $95,000, which represents the $100,000 that you paid for the truck minus the $5,000 that we've depreciated it.